Austin Hill.
I'm Nicholas Amrine.
I'm Thorvald Beam.
I'm Tyler Church.
We're presenting a financial analysis of Advanced Energy, representing Colorado State University. Advanced Energy was founded in 1981, headquartered at Fort Collins, Colorado. They currently have a market cap of $2.72 billion, and they were taken public on the NASDAQ in 1995. We issued an investment call with a $94.99 price target, presenting a 25.2% upside. This is due to their end market growth, historical market strategy, industry-leading financials, and our valuation deals in upside.
Advanced Energy's direct customers in the semiconductor equipment market lead to customers in the electronics and data economy market, which have large market size. Advanced Energy provides innovative products. They pride themselves on providing efficient and precise power products. Their two main power systems are advanced power and embedded power. Advanced power is used more often in semiconductor, industrial, and medical. An example of a medical power supply would be the CoolX fanless power supply. Embedded power is used more often in data center and telecom. An example of a power system used in data centers is the power shelves.
So here's Advanced Energy's revenue by segment. Currently, more than half of the revenue is coming from the semiconductor market, which is a highly cyclical market. And if the semiconductor market's at a low point or at the end of a cycle, they limit their CapEx spending, which is going to directly affect a company like Advanced Energy. But their second biggest revenue driver for the company is industrial and medical. And this is can help offset some of the losses that they may see in the semiconductor end of cycle. The other two are data center computing and telecom and networking, and these are two segments that they have just picked up in the Artisan acquisition, and we believe these are going to be high growth segments that help diversify themselves away from the cyclicality of the semiconductor market. Here's Advanced Energy's revenue by region. They are currently getting close to half of their revenue coming from the North American market, and then close to 40% of their revenues coming from the Asian market, and both these have seen high growth in the past, and we believe that they're going to continue to see high growth, specifically in Asia, because it's an emerging market.
To identify macroeconomic drivers, we ran a series of regressions against Advanced Energy's revenue by segment. Specifically looking at the semiconductor industry, we found industrial production of semiconductor explains 64% of the variance in semiconductor revenue, as shown by our R-squared value. We forecasted growth in the industrial production area, which we then used to forecast growth at an overall 13% compound annual growth rate. These growth predictions are based on growth in Internet of Things, advanced technologies, as well as renewable energy. We ran a similar regression on the industrial technology sector and saw a slight dip in production in the early 2020 with recovery throughout the year. When accounting for the growth in medical in that segment as well, we found an overall 22% compound annual growth rate.
Per Bloomberg, 5G is expected to grow in future years. This will lead to more 5G infrastructure being built. This will then drive the network and telecom sales to increase. Also, the 2019 estimates are only based on 6 months post-acquisition, and this will also increase sales. And we also see data center sales increasing in future years as well.
When looking at the key ratios, it's clear that Advanced Energy excels in operating margins. We believe that they will leverage these high operating margins to gain market share in the newly acquired telecommunications and network, as well as the data center areas. They lead in returns on asset and returns on equity in all areas except for industrial technology and medical, which we attribute lower returns on asset due to the Artisan acquisition, which came alongside $140 million worth of goodwill, as well as the fact that comparables in this area tend to have higher returns on asset due to the nature of that market.
Here's a brief overview of Advanced Energy's research and development, which we believe they have a competitive advantage in. The average semiconductor cycle length is short at 13.4 months, which means innovation is key to remaining sustainably competitive within this industry. In addition, there are high barriers to entry, and the industry is very capital intensive. Advanced Energy outspends all their competitors on R&D expense to sales, and we project them to continue doing so moving forward. This has led to a strong patent portfolio of over 450 plus patents, 12 global design centers to cater and customize their products to their customers, numerous research and commercial partnerships that we believe will drive innovation. And they recently introduced Power Insight Analytics this previous business quarter, which is a machine learning software which will provide efficiencies for their customers and their power supplies.
So Advanced Energy acquired Artisan from a private equity company for about $400 million all in, and to help facilitate this acquisition, they took out a $350 million interest-only loan at 2.76%, and they pay interest for the first few years, and then at the end of the loan, they can pay off the principal or decide to roll it over. But based on their current ratio and the high holdings of cash that they've historically had, we believe that they're just going to pay it off in 2024, which is the end year. Based on this is also reflected in our solvency ratios, which we believe that they're not going to take out further debt to continue the operations of their company or make big acquisitions similar to this. And their debt ratios and solvency ratios continue to get better as the years go on.
Our valuation is based on a 75% blend of multiples analysis as well as a discounted cash flow weighted at 25% to achieve a target price of $94.99. We ran a scenario analysis identifying the worst base and best case scenarios, with the worst case scenario returning to a stock price that we saw last September, a base case scenario having a 25% upside, and a best case scenario having a 94% upside. We ran a Monte Carlo analysis which analyzed previous returns to create a distribution, and we found that the majority of the cases were centered in the base or best case scenario. Our multiples valuation, we broke down Advanced Energy by segment and found pure play competitors in each of those segments. When we found the ratios of the comparables, we averaged those at the weights that the percentage of revenue that Advanced Energy had in each of those segments. That comprised 80% of our model. The other 20% came from general comparables that we found represented the conglomeration status of Advanced Energy. We used price to earnings, price to sales, price to book, and EV to EBITDA to attain a target price of $93. Our final weightings of each of these multiples were determined based on our optimization program.
To find the best proportion of multiples, we collected 10-year historical data. We then ran a multi-factor regression, and then we used the optimization algorithm to give us the weights we used for our multiples.
For our discounted cash flow, we used a free cash flow equity model because of the firm's current debt leverage state. We attained a cost of equity of 11.56%, derived using the CAPM model, a market risk premium of 6.88%, and a risk-free rate of 1.85%. This resulted in a $98.74 share price. Over 50% of Advanced Energy's revenue comes from two customers, Lam Research and Applied Materials, which leaves them highly customer concentrated. However, we believe they're going to dilute this customer concentration in the future with their newly acquired segments in Artisan. And an example of this is Aero Electronics, which they picked up from the Artisan acquisition as a customer, and they have a high electronics distribution network.
For risk, we identify some possible concerns with the Artisan acquisition. Specifically, they acquired over 8,000 employees, which is 4 times the amount they already had. We also see that they acquired approximately $66 million in pension liability, and when considering Artisan's operating margins compared to Advanced Energy margins, we identify some concerns which we reflected in our DCF by dropping operating margins in 2020 and having them steadily recover over the next few years as synergies improve. For macroeconomic risk, we see a slight reduction in manufacturing reflected in those regressions that we mentioned earlier, as well as some Chinese geopolitical risk in which China has been taking intellectual property from American companies, therefore making them not have to use the R&D expenses. We ran a tornado analysis to identify revenue, cost of goods sold, and operating expenses as the 3 largest variables that impact our discounted cash flow and the 3 variables to most observe going into the future.
And then here are some drivers for the company. We believe that Advanced Energy is poised to benefit from the rising demand of highly efficient and customizable power systems that can be reliable. And the recent acquisition of Artisan and further acquisitions down the line expands their product offerings and reduces their exposure to the highly cyclical semiconductor equipment market. They have industry-leading financials and high margins, which we believe they can use to leverage to better take a foothold into these new types of markets, forcing other players out of the market. They have an established inorganic growth strategy and an industry that we believe is consolidating, and that's the last 6 years of their acquisition history. They acquire companies for majorly 2 reasons: to pick up a new type of technology, as in with the Excelsis merger, or with the Excelsis acquisition, they picked up a new type of medical device to better have a foothold into that market. And with the most recent one, Artisan, they picked up 2 new high-growth segments.
And we would just like to reiterate that we issue a buy with a target price of $94.99 and a 25.2% upside. This is due to in-market growth, the growth of Internet of Things, 5G data center, and the semiconductor recovery, or cyclicality recovery, market strategy, their qualified management, and inorganic growth. Their attractive growth segments, their industry-leading financials. They have high margins, revenue growth, cash holdings, and large upside potential, undervalued, blended valuation, and limited risk.
Thank you.
Thank you.
You guys.
So the company spends a lot more on R&D, but yet they acquire acquire technologies as well? It seems like it's two different strategies. Is management kind of confused here?
So the way that we see this is that they identify opportunities where they don't have to spend as much on R&D compared to if they were to research itself. So if a company has an established technology in an area that they're looking to acquire, they're going to much rather just buy that company out rather than spend that millions of dollars possibly researching and possibly getting the results. It's a guaranteed result.
So in your R&D percent growth going forward, you had the R&D percent staying about the same, post-Artisan as it was pre-Artisan. And yet Artisan's gross margins are much, much lower. So what did we do buying a company with much lower gross margins, almost commodity gross margins, and yet still spending the same percentage on R&D?
I can answer this question. It's a great question. The semiconductor market, as also stated in that slide, is 13.4 months. Innovation is key. You guys need to spend money on research and development in order to keep your products, particularly in the semiconductor segment, ahead of your competition. And also, you need to increase your R&D expense because you've acquired 2 new segments, specifically telecommunications and data centers. And although Artisan did bring technology to your company, we made an assumption that you guys would continue to spend a high percentage of sales per year to compete in those industries.
The acquisition, the Artisan acquisition was a multiple of anything that they've acquired before. What makes you so sure that this is going to go smoothly, and how do you incorporate any related risks into your valuation?
So we believe that management has a established history of being within the mergers and acquisition spaces in the old. Could you switch to the manager slide, please? Specifically for Neil DeGrieger and Paul Oldham, they were in companies before trying to either integrate them or helped their company merge a new type of company within. And these are all also new managers as of 2018, except for Yuval Wasserman, who has been with the company since 2014. So we believe that they're going to be able to successfully merge this company into Advanced Energy's framework.
Does that justify any sort of additional risk and perhaps impact the valuation of that?
We take account of that with, mostly we look at the margins of the Artisan acquisition. Obviously, Artisan had much lower margins than Advanced Energy, but that we also accounted for that in our DCF, where we're saying that it's 9% operating margin. So maybe Nick would want to take this question.
If you could pull up the DCF, it should be the first one on the second row. So, might not be. If you go back, I can talk a little bit about it, but we do have that in our. Maybe I think it might be a cash flow statement actually, where we have our second row, third from the bottom. Yes, so if we look at our operating margins, we do decrease those to 9%, improving steadily. So that did impact our valuation quite a fair amount. And we did take that into account, especially when looking at the DCF specifically.
I guess as you think about AE's business model and Artisan's business model, and Artisan having so many more employees, like why do you think Artisan operates that way? They would have 4x the number of employees and then lower revenue.
So the Artisan product line is a lot different compared to what Advanced Energy had before. Advanced Energy, since they were doing a lot in higher end power systems for semiconductor, they were a lot more expensive. So they were like $40,000, $50,000 power systems, and then the Artisan acquisition adds a new type of price lining for them, and it's for different industries. So it's a lot of smaller, lower priced modules, and they would have to be able to sell these because it's a lower barrier to entry into the market. So they have to have the employees to be able to sell these as well as research them and etc.
Why did you use a Monte Carlo simulation? What were some of the advantages of using it there?
We ran a Monte Carlo simulation just to show our historical prices, where they end up 1 year, and sort of determine our best and worst case scenarios, and just sort of give us a range of prices.
Yeah, it was supplemental to the valuation. It's based on 5 years of historical daily returns. So it wasn't necessarily taken into account in our valuation, but it was just something on the side to kind of say, how will these historical prices maybe affect the price in the future? We did see an all-time high of around $94 just 2 years ago for the company, so we felt it was important to capture what exactly happened in those years.
Why did you discount or de-rate the worst-case scenario on a discounted cash flow? What was the rationale for that?
What do you mean by D-rate, sorry?
You didn't really weight that as heavily as the best case, and was that, am I correct on that?
We weighted the DCF and the multiples differently, and we had a worst case for both the DCF and multiples, so I think that would be what you're looking at.
Yeah, we didn't weight the worst or best case scenarios. Those were just augmenting revenues, future cost of goods sold, to kind of get an idea of, okay, hey, if they are 15% higher expected revenues, what would the price look like? Maybe 10% lower revenues, what would the price look like? So they weren't actually incorporated into our final share price, more of just a way to look at the upper and lower bounds of what might be possible in our financial analysis.
So we kind of use the Monte Carlo as like a visualization of the probability distribution based off of the best, worst, and base case.
The terminal growth rate of 4.5%, why is that reasonable?
We looked at GDP growth and inflation rates. Inflation rates